How do you manage risk with a delta-neutral straddle? If you are curious about how to effectively manage risk using a delta-neutral straddle in options trading, you are in the right place. Let's break down the key strategies that traders use to navigate this advanced concept. A delta-neutral straddle involves buying both an at-the-money call option and an at-the-money put option simultaneously. This setup aims to keep the overall delta near zero, which means the position is less sensitive to small price movements of the underlying stock. However, maintaining that delta neutrality is an ongoing task. As the price of the underlying stock fluctuates, the delta of each option changes. One option's delta may increase while the other's decreases. To counteract this, traders must actively monitor their positions. If the delta shifts to or from zero, they may need to buy or sell shares of the underlying stock or adjust their option positions. This rebalancing helps limit directional risk and keeps the position hedged against minor price changes. Another important aspect is managing gamma and Vega exposure. A long straddle typically has high gamma, which means the delta can change quickly with price movements. This can increase risk if not handled properly. Additionally, a long straddle has positive Vega, meaning it benefits from rising implied volatility. Traders should be aware of these factors and adjust their positions if they notice a drop in volatility or if gamma risk becomes too significant as expiration approaches. Time decay, represented by theta, is another factor to consider. Both the call and put options in a straddle lose value over time. As expiration nears, this decay accelerates. Traders need to keep a close eye on their positions and may decide to close or adjust the trade if the losses from time decay start to outweigh potential gains. Setting risk limits and exit strategies is also essential. Traders often define maximum acceptable losses or specific price movement thresholds. For example, if the underlying stock moves significantly beyond the strike price, the straddle can become imbalanced and riskier. In such cases, it is wise to close the position or make strategic adjustments to mitigate potential losses. Some traders also look to generate income by holding a long straddle while selling short-term call and put options against it. This strategy can produce premium income that offsets the cost of the long straddle, thereby reducing overall risk. However, careful management is necessary to avoid assignment and maintain delta neutrality. Lastly, frequent monitoring is key. Maintaining delta neutrality requires regular adjustments, which can lead to increased transaction costs. Traders must weigh these costs against the benefits of staying delta neutral. In practical terms, managing risk with a delta neutral straddle involves balancing sensitivity to price movements, volatility changes, and time decay while actively adjusting positions. This approach aims to profit from volatility rather than price direction, requiring discipline and attention to detail.